It's just good to be proactive in this space. My boss got a call at 3 p.m. on 12/31 asking if he could donate a house. You can, but not by 12/31.
We had a client who owned property and he wanted to sell his property. He never told me. And the tax rates got worse for him and it cost him tens of thousands of dollars.
Hi everyone, welcome to Chimes Dimes, brought to you by First Wealth and Trust right here in Winter Garden. I'm Pete Baksh, Chief Investment Officer at First Wealth and Trust. And today I'm joined by Steve Jerina, Vice President of Philanthropic Strategies and Partnerships with the Central Florida Foundation, and Jen Mitchell, its CEO of AccountSense. Starting things off first, we want to thank Hangry Bison for allowing us to film in this awesome space. The food here is amazing. I can attest to that personally, but they were founded in 2018 as a create-your-own burger place and now known for bison burgers, craft cocktails, and amazing whiskey selection. And there are currently 3 locations, Winter Park, Lake Mary, and here in Winter Garden. Once again, thanks to Hangry Bison for letting us film here. So starting off, let's get to know each other a little bit. Jen, can you tell us a little bit about your background?
Sure. I am a CPA. I started AccountSense 20 years ago, where my passion is really helping people save money. And we do that through saving money on taxes, working with small businesses, high net worth individuals, and most specifically women-owned businesses.
Okay. And what is AccountSense?
AccountSense is a CPA firm. We are nationwide. Small team of about 10 incredible accountants and CPAs that do accounting, payroll, advisory, and tax services.
Okay. And Steve, can you share some of your background, what you do?
Yeah, so I'm with the Central Florida Foundation. This is our region's community foundation. I've been basically in nonprofit work, donor-facing roles, fundraising, my entire career. So about 15 years now. Started off, as a college student, dialing for dollars because I needed pizza money. And now I've moved on from needing food, but now I get to work with high net worth individuals here in Central Florida to help formulate philanthropic plans and also work with their advisors on charitable gift strategies from a tax perspective, from a wealth management perspective, and also an estate planning viewpoint as well. So that's me in a nutshell.
That's great. And can you elaborate a little bit about what the Central Florida Foundation is?
Yeah.
For those that don't know.
We are our region's community foundation. So we serve the broader 7-county Central Florida area, Greater Orlando, and we build community by building philanthropy. That's our motto, that's our mission statement. It's what we wake up and think about every day.
Yep.
A lot of people, when they think of a community foundation, and there's hundreds of them across the country, they think of donor advised funds, and they also think of helping donors think about their legacy, their charitable giving after they're no longer with us. There's tons more we do. I could talk forever about it, but that's really the core of what we do.
It's great. Thanks for sharing. And we're going to get right into the weeds. Since you just went into it, I'm going to start with you, Steve.
Sure.
What are current trends that you're seeing in charitable giving?
There's a lot going on in the charitable giving space right now, and I really think it's anchored by 2 things. One is fairly immediate, and the other has been going on for some time. The long-term trend that's affecting a lot of the current events in charitable giving is the growth of donor advised funds across the country, not only in the organizations that provide them, but just in the sheer number of donor advised funds that people are opening, that families and individuals and businesses are opening to streamline their charitable giving. The other factor that's affecting a lot of current events in charitable giving is last year's major tax legislation, HR 1, or the One Big Beautiful Bill. There was a good amount of charitable provisions in that legislation that are really affecting how people think about their charitable giving plans and how they're interfacing with their advisors, such as Jen, to really be cost effective, but also be impactful at the same time.
Yeah, that's great. I'm sure you're seeing a lot of impact from that.
Yeah, absolutely. We definitely see a lot of the donor advised funds, and that helps us with bunching strategies to get the most out of their tax deductions. That's really where I come into it, is to try to save people money on the deductions. They've already decided that they're charitable and that that's what they want to do. So I'm trying to work the angle of how to save them the most.
Sure. And I mean, elaborating on that, can you give me kind of a technique that you use? I mean, I know in the trust department at the bank, one of the things that we do is we get our clients to take an IRA, RMD, required minimum distribution, and have it go directly to some fund or some foundation. And I'm not sure if that's the best.
Yeah, absolutely. For the elderly, people over age 70 and a half can do the qualified charitable distribution. And that helps a lot, especially for people who are not able to itemize. One of the other strategies that we use is the bunching strategy. So the standard deduction has gone up a lot. It's, I think, $32,000 and change for 2026.
Oh, wow.
And for a married couple, and that's a lot. So several people don't get over that limit, but they may want to donate to their church or wherever, and then they're feeling that they get no tax benefit for that because they're not itemizing, they're not deducting their donations.
Right.
So we'll do a bunching strategy where you can make a sizable donation in 1 year to rise far above that limit and be able to deduct those donations.
Oh.
And then in a following year, you don't donate, or you donate much less, you fall under that standard deduction.
Yeah.
And so then you're getting the best of the free government deduction, and you're getting to take those charitable donations. And as Steve pointed out, that's typically done through a donor advised fund, or most easily done through
Donor advised. So that word's come up quite a few times, but we haven't really defined what that means for the people that might be watching.
The donor advised fund is the most popular, fastest growing charitable vehicle across the world, definitely in the United States. And there's a couple different ways you can describe it. I don't think any one is perfect, but there's a variety of ways. One, you can describe it as your own mini foundation, or some people have described it as your charitable bank account, right? And they're all true in a certain regard, but at the end of the day, they all function the same, regardless of what organization you're partnering with to work to open your donor advised fund, or DAF, D-A-F-S, sign a fund agreement of some capacity, or you fill out a form with the sponsoring organization, and then you make a gift to that sponsoring organization, which then allocate those dollars into the fund. Those funds then get invested into the market, right? And at the same time, when you make that gift, you get the tax benefit when you make the gift into the fund. And that's a really important distinction. And what happens is later on down the line, it could be the next day, it could be the next month, it could be the next year, it could be 10 years, 5 years, 3 years down the line, you can then make a grant, and that's the key word, the grant out of the fund to nonprofits of your choosing, like Rollins College, Central Florida Foundation, United Arts, United Way, your local humane society, whatever your passions are as a donor. The donor advised fund allows you to think about the tax strategy separate from the impact strategy, while also keeping administrative fees low, paperwork to a minimum. It makes tax filing season so much simpler, and it's also a really powerful vehicle to think about those different strategies based off new tax legislations that have been coming out more and more, with such as the Tax Cuts and Jobs Act in 2017 and last year's OBBB.
Yeah, I know a lot of people think of their tax planning as kind of an annual chore and something gruesome to do, maybe even. In my case, I know I don't really enjoy that too much. But for you, beyond the fact that that's got to be a busy season, right,
Sure,
this spring, how does a tax advisor impact an investor's strategy? And why is it important for an investor to have a really good CPA?
Yeah, absolutely. I like my clients to think of me as like their new best friend that's a CPA, because I want them to call me throughout the year. I want them to ask me questions throughout the year. tax planning doesn't happen on April 15th. That's far too late. So being able to plan ahead, timing is everything.
Yeah.
If I hear about it when it's too late, I really can't help you plan for it. So for me, it's really having good discussions with my clients on either a regular basis or just being available for them to ask the questions and for them to feel comfortable, because it's not like going to the dentist when you come to the accountant. It really should be a good thing, helping you learn how to be more strategic with your wealth.
Sure. That's one of the things I've come to realize in my portion of the business is investment management, is that it's really a people business. It's never about just the numbers that are either flashing on the screen or in the spreadsheet.
It really is a trust-based industry, right? Mm-hmm. Even on the nonprofit side, donors support the organizations they care about because they trust the CEO, they trust the mission, they know the good work. Maybe they live down the street and so they see the good works every day. It's about feeling and trust. It's not necessarily a tactical decision all the time, and how people work with their advisors isn't too different.
You know, I brought up on this list I've got here with the IRA thing, and we kind of covered that. What are some other ways that you help, an investor maybe find a tax advantage strategy?
Sure. Well, one really great strategy is to, rather than donating cash, which most people do, right? They write a check to their church or whatnot. You can actually donate property, including stock. So if you have a stock that you purchased for a low price that's now worth a lot more, if you sell that stock, you're going to be paying capital gains tax on that. Right. And then you could donate the cash to your charity of choice. But if you donate the stock directly to the charity, you can avoid paying any tax on the gains and get the full fair market value deduction for making the donation. So it's really a win-win, and that's an incredible strategy for people who have the built-in gains in their taxable investment accounts.
Thank you. That's a really great one. We see that in my team quite frequently, where someone has maybe even inherited some stock, and because there's no step up in the cost basis, which for the public out there, that just means that, upon a transfer, if somebody is deceased, they get a step up in the cost basis so they don't have a gain. But that only happens once. And when it gets gifted over again, they might have a huge position in Coca-Cola or something like that. Never going to sell it. Grandma gave me that stock. I'm sentimental with it. And if I do sell it, I owe a ton of money. So
yeah, and a gift is another situation, because a gift you receive from someone you receive their stock basis, so you don't have any step-ups in play. So a lot of times my clients receive gifted stock, and that's the kind of stock that makes for a great donation.
Makes sense, yeah. So I had in my notes here something called the Peterson-Waterstone case. Yeah. Can you elaborate on that?
Yeah, so I mentioned before, DAFs are this really fast-growing vehicle across the country, right? They're the charitable vehicle of choice. And what's happened is that it means people are using them more, which is great, because we know that when people open donor-advised funds, they become more generous, more community-oriented when they open up a donor-advised fund. But it also means it's in the news more, right? Which can be great, but it can also be, bad, depends on who you are. There's this court case right now, and this was released in the news maybe around February or March. There's a donor advised fund sponsor based out in Colorado that's faith-based. So the donors who open up DAFs with this organization tend to leverage that organization and their DAFs really in a faith-based orientation. Okay. Christian, right? That's where they're making their grants. They're making them to houses of worship. They're partnering with that organization because they want to make grants to organizations that align with their faith-based values.
So that makes sense.
These are great organizations doing great work, and there's multiple of them serving ideological lines, houses of worship lines, you can name it. Successor advisors can be built into the donor advised fund, which means, Jen, if you open up a donor advised fund, you can build into the fund agreement that when you are no longer here, your children can then start making grants out of the fund. Now, the key word here is grants, but also advised, donor advised. When you open up the DAF and you donate the money or the stock into the DAF, you relinquish control. It's no longer your money. And this is a really important distinction to make. Because the donor advised fund sponsor legally owns any assets that you gifted. The donor just retains the advisory privilege.
Interesting.
Now, the whole business of donor advised fund is built on staff sponsoring organizations, leaning into donor intent and honoring donor wishes and basically saying, yep, as long as it fits the IRS rules, we'll honor that grant request and push it out. There's really not a whole lot of reasons in the DAF ecosystem to ever really say no. Yeah. The only time is when a nonprofit organization falls out of good standing with the Internal Revenue Service, right? And we don't really hear of that happening quite often. It's usually because they are a small organization and they basically forgot to file some paperwork.
Yeah.
In this particular instance, Waterstone has basically stopped communicating with the successor advisor of a $20+ million donor advised fund. The original donor has since passed away. The successor advisor is now the lead donor advisor on the fund, right? And I don't know what happened, but apparently there was some sort of breakdown. And so the successor advisor is now suing Waterstone. And basically, what's really, really important here is that successor advisor is asking the court to basically make a determination on does he have a legally enforceable right to advise grants out of the fund. And I'm not an attorney, and I know this is maybe a little bit too in the weeds, but this could have huge ramifications for the entire DAF ecosystem. This really isn't normal. This is not a normal occurrence. I've been working in this space for 15 years, and I've never heard of grants being turned down other than because the nonprofit organization fell out of good standing with the IRS.
Yeah, but this is sizable to set a precedent.
Yeah. Right. Yeah. And so, this is pretty cutting edge. We'll kind of see where this goes. There really hasn't been a whole lot of updates on this in the last couple months, but we'll see. I imagine this is going to be a slow drip.
Yeah, I mean, the implications that you mentioned, you've got increased regulation of the industry coming, I'm sure. Even just from the scrutiny of this thing, regardless of how it turns out.
Yeah, when any industry gets larger and bigger, it's naturally going to bring on increased scrutiny, right? All of a sudden, someone's going to poke their head under the hood for good or bad, right? Yeah. And this is in anything, everywhere, at any time, right? We all know this. I think this is an interesting conversation to have in this space. I'm excited to continue to learn and hear about where this goes.
Sure. Jen, I've got a question for you here.
Sure.
A lot of folks maybe are wondering what the limits are in any given year for your gifting. Can you elaborate a little bit on that?
Yeah, that's a loaded question. There's a lot of different limits as far as what can I deduct and how much can I donate. That's going to depend on what you're donating. So for 2026, the limit for cash donations was set at 60% of your adjusted gross income.
Okay.
That's pretty high. I don't see a lot of clients making that sizable of a donation, but you never know. If you're independently wealthy and your income is, you're not living off of it or whatever, then yeah, I could see that happening. If you're going to donate appreciated stock, like we talked about, that's going to be at 30% of your income. And then there's various other limitations for differing donation types.
So what about this? Because, obviously this is your wheelhouse, not mine. But I know of cases where much larger donations than that have been made, or, if you gifted appreciated stock, for instance. How are they doing that?
Yeah, so once you hit that limit, that's all you can deduct in the current year, but those then carry forward. So then on next year's tax return, the excess would be deducted next year, and so on and so forth if it continued to flow over into multiple years.
So in a sense, you've created a tax asset that has a future life when you make that gift.
Yeah.
And the deduction is only brought to the return each year consecutively to those limits.
Yep.
That's good information. Thank you.
Yeah, you're welcome. There's a new kind of wrinkle to that with the tax law changing for 2026, in that there is a deductible or threshold amount where if you make donations, you have to exceed 0.5% of your income. So if you're $100,000 of income, the first $500 of your donations just don't count. And so if you have this flow over situation from last year, you might start losing this 0.5%. And that's never been the case before. This is a new limitation.
I wonder where something like that would come from Washington, but who knows?
I mean, there was a lot of back and forth in the one big beautiful bill.
Yeah.
I think they had to put some floors in there and some caps in here to kind of offset things. And so I don't think anyone on Capitol Hill is really looking to hamstring charitable giving in any real way, right? We all love charitable giving, right? And we all love the idea of giving back to our community, but they had to make it work, right? And so you have these nuances here and these nuances there that just make it work. There's also there's the cap and the floor.
Right.
Right?
Oh.
Right.
So the floor was that 0.5%.
It's the 0.5%.
And the cap is what you explained to me just now.
Correct.
Okay. So there's been some talk about some recent changes at the Postal Service and how, is there a way that's impacting you?
Well, not me personally, but in the charitable sector overall, the end of the calendar year is always the busiest time, right? This is when you need to make those gifts in order for them to count for tax purposes, right? Tax day is April 15th. I know this because my dad is a CPA. I'm the son of an accountant, so I always knew that April 25th was the big tax filing day. But the charitable giving deadline for those gifts to count for taxes is always December 31, 11:59. Well, traditionally, you were always able to drop a check in your nice blue USPS post office box at 11:55 p.m. on 12/31, and it would count for tax purposes because the post office would postmark it, that tax year. Always super convenient. Well, now that's not necessarily the case, and it's requiring our charitable folks to be a little bit more proactive than maybe some of them are accustomed to being. And what's essentially happening is that the post office, the USPS, is going to be taking those envelopes, those letters, to a regional facility that might not be where that letter was dropped off and time stamping them there. So potentially, if you drop a charitable donation in the mailbox at 11:30, 11:45 p.m., it might not get postmarked until January 1 at 4 a.m. And that means it doesn't count for that tax year. And that's really, really important for those folks who are itemizing, right? Who are trying to leverage charitable bunching strategies, who are trying to get above that floor, stay below that cap. Whatever it is, it's requiring folks to be more proactive. So I always say, if you're worried about that deadline and it's 24 to 48 hours before 12/31, just swipe the credit card online.
Yeah. I was about to point out, well, that would probably increase the amount of electronic payments being made.
That's how we're advising folks. That's how I'm telling advisors to tell their clients what to do is if it's real close to 12/31, probably best just doing it online.
Yeah.
Don't risk sending that check in the mail. You just can't guarantee that timestamp's going to be in that calendar year.
Let's close on some fun stuff. There are always stories. My business has some fun stories, and yours both do too. Why don't we start with you, Jen? Memorable, something interesting, maybe funny, something that stands out.
Oh, you might have to come back to me on that one. We have so many stories in taxes, but give me a second to think about that one.
I'll give you a second to think about that and go to Steve. Do you have one for me?
Oh gosh, the world of philanthropy is full of interesting ideas because it's filled with good people wanting to do good deeds for their community, and people want to donate all sorts of things, right? Jen mentioned that you can donate more than just cash, right? You can donate publicly traded securities. Well, that's still a fairly streamless, easy transaction to make. Mm-hmm. But you can donate things like a second home, or, I'm from the Midwest. You can donate corn crops, right? You can donate oil and mineral rights if you're out in the mountain region. Right? You can donate anything that has a value to it. However, that doesn't mean that you can finalize that transaction by 12/31. I wasn't in this story personally, but a couple jobs ago, my boss got a call at 3 p.m. on 12/31 asking if he could donate a house The answer's you can, but not by 12/31.
Yeah, because that would be a title agency has to be involved.
There's got to be an
or a deed.
appraisal, right? I mean, it's just no.
Yeah.
So the lesson here is that if it's not cash or publicly traded asset like a Microsoft stock, an Apple stock, Nvidia, be proactive. Advise your clients to start thinking earlier rather than later, because there's a process, there's a due diligence methodology that needs to be followed to ensure that not only the charitable organization is doing right by the donor, but that they're not accepting anything that they might not want to take on.
Yeah.
So it's just good to be proactive in this space. And I would contend, and you may agree with this, is that given last year's tax changes, it's requiring people to be more and more proactive as opposed to being reactive now. Charitable giving is really becoming a more planning-oriented space.
So did you get enough time?
I don't know that anything in taxes is really all that funny, or what I find funny might not be something to you, but I can tell you a story of, we had a client who owned property and he wanted to sell his property. Unbeknownst to me, he never told me, and the tax laws were changing. This was back, I think, 2017 when the tax laws were changing, and the tax rates got worse for him. And had he talked to me, I would have talked to him about timing, but he didn't. So he sold it the following calendar year instead of the current calendar year, and it cost him tens of thousands of dollars.
So there's a moral of this story. Keep in good touch. Talk to your accountant.
Yes.
And,
Plan ahead.
Yeah.
I always like to say, your accountant is probably your most trusted advisor.
And I'd have to agree.
Yeah.
So we've learned a lot. Thank you both, Jen, Steve, for coming on. And thanks to the Hangry Bison for giving us this beautiful space to tape in. And thanks to you out there in the audience for watching and listening. Now, what we're talking about here, these are complex topics. These are general in nature. They're not meant to be taken as personalized advice. But if you would like any of that, reach out to any of us on our topics of expertise, and we're happy to do that. If you enjoyed this presentation, hit that like and subscribe button. We'll see you in the next episode.